Well, good morning then everyone as we head into European trading on Wednesday the 13th of March. We'll have a flick across markets as markets have moved on from inflation yesterday pretty quickly. Ended up being a little bit of a nothing print, but we'll have a look at the calendar once we get around. We can see dollar steadies as traders brush off US inflation surprise. Certainly a lack of volatility across currencies over the course of the night. Not much to do with stocks either. Yields are a little bit lower after being higher yesterday, but as it says in the headline, markets have shrugged off or brushed off. It says US inflation, and that has happened pretty quickly. What the markets are talking about, though, which I've said this for a number of weeks, but sort of becoming more and more front page news, is the Bank of Japan. Now, the Bank of Japan themselves, Governor Ueda has come out, has said, a number of times that, they want to see an increase in wages in order to say that they are sustainably out of deflation. And then they can look at exiting their monetary stimulus and negative interest rate cycle. So, which they've been in for a decade. So that is a big thing in Japan. Stop printing money. It's technically printing money, but it's the easier term of explaining it. Kind of printing money and negative interest rates, as I said, for a near decade now. They are looking at exiting that. They have made they have made changes to the yield curve control program, going from 0.25% upper band up to 0.5%, and then a loose band of up at 1%, and that has risen, which is then hawkish steps. They're allowing kind of longer dated interest rates to rise. Now they're looking at shorter term interest rates and actually raising the interest rate rather than letting bond markets sort of do it for them. So when do we get that? We still will want some wage data out of Japan. But a couple of things. Toyota overnight, obviously one of the biggest companies in Japan, have announced that they are going to give their biggest pay rise in 25 years to a number of staff members, or to a lot of their staff members. So that is a step in the direction of an increase in wages, which is then another step for the Bank of Japan to go and hike interest rates. Unions and people have put forward, or workers have put forward to request to unions to get wages higher, and a number of the biggest companies in Japan have agreed to workers' unions to then go and raise wages. So, Toyota, the kind of one company that's been named, but one of the articles here said big Japanese companies. Here you can see big Japanese companies have agreed in full to union pay demands, which doesn't give us an idea of exactly what companies, but Toyota being one of them. Other big companies in Japan agreeing to up wages is a sign that we are fast approaching the end of negative interest rates and the end of pretty much unlimited monetary stimulus in Japan. What that means then is likely to be some strength in the Japanese yen. We obviously had a big bout of upside in the Japanese yen that was kind of fueled in part by the US dollar pushing lower, but the Japanese yen certainly having a good time of it over the course of last week, due to comments made by central bank officials from Japan saying may get one in April. But some market participants are even backing we may get that exit from Japan as early as next week, but that's not market consensus so far just yet. But there is some market participants kind of waking up to the fact that we may actually get that over the course of next week. But we'll cross that bridge when it comes to it in a few days. We'll see what more headlines come out over the rest of this week, and Bank of Japan next week. Maybe an interesting meeting. When we get to it, we can see your Aussie just all over the place after CPI yesterday. These candles, big long-legged dojis, if you want to call them that, off the back of CPI yesterday. But post CPI, you can see your Aussie, Kiwi, Euro, and Sterling doing nothing. Dollar Swiss, dollar CAD, dollar Yen doing nothing. Equities kind of grinding their way higher, not exactly by any sort of aggressiveness. But your S&P, your Dow Jones, your Nasdaq, your Russell. Certainly the three main ones slightly higher post CPI. Russell is kind of back where it started and never really left too far from where it started. So not much to see here on US stocks, albeit they are still higher. Any day stocks are higher. Probably have to look at buying them again in the next day, just simply due to the fact that we're through that inflation print. Wasn't too much higher. There's never going to be a linear trend down in the price of inflation. Still do have work to do, or a little bit more work to do, but probably not enough work to prolong hiking into or cutting interest rates, should I say, for that much longer. You see the DAX pushing higher, Eurostox pushing higher, the FTSE having a good time of it at the moment. Some signs of the UK economy starting to starting to pick back up a bit, but we'll have a look at that now in a now in a minute. 10-year yield, 2-year yield, 10-year yield pulling back a bit, 2-year yield a bit sideways. Thing is still inverted. Higher or shorter term interest rates are longer, or higher, should I say, than longer term interest rates. So still a bit of negativity in terms of the yield curve, but that hasn't really normalised for a while now. They're pushing higher post CPI yesterday. Do they reprice back to where they started? That continues to push lower. Should probably be supportive for equities. Should probably be negative for the US dollar. GDP figures out of the UK this morning. 0.2%, not too bad. I mean, the 3-month average is not great, but more over the month of January, not too bad. Maybe January sales contributing factor to that. But figures for the month of January, certainly after Christmas. After Christmas has ended, obviously not a lot of people go out and spend that much money in January, so 0.2% increase over the month of January isn't too bad. A couple of these other figures not fantastic, but there has been a number of data prints from the UK that have been okay recently. Unemployment not great yesterday, GDP okay today, but some kind of early signs that the UK economy actually may be that bad as people may have anticipated. Now, over the course of today, not much out really for us to go off. You got oil inventories, you're a trader of oil at 130. We'll see how that plays out, but ultimately you got to work off what's been going on recently. I still think US dollars lower, stocks higher is probably the better way to play it. I don't think that inflation print from yesterday changes too much. If those yields continue to push lower, again, that should help those two moves. But I don't say that with a massive amount of conviction. Japanese yen should be the currency on everybody's watch list at the moment. Does it get going today is another question, but certainly upside in the Japanese yen is something you got to keep an eye out for in the coming days and weeks ahead. We'll cross the Bank of Japan next week when we get to it. Up until then, it's probably the side of the fence you need to sit on. Might not be the busiest of trading days today. We've got PPI and retail sales tomorrow. May kick markets into gear tomorrow. But remember, economic data out an hour earlier. The oil inventory is normally 3:30, 2:30 today. US Open comes at 1:30. So just keep that in mind. Don't get too caught out. But maybe a little bit of a tricky day of trade today. But I guess we got to see how it pans out.